Hello everyone, today I'm going to discuss on 6 common psychological traps or mistakes that investors should avoid when investing and how we can overcome them. As usual, before I dive into the detail, hope you can help with the YouTube algorithm by liking this video. Your little support means a lot to me. Okay, first up, confirmation bias. Warren Buffett, the godlike investor, once shared, what the human being is best at doing is interpreting all new information so that their prior conclusions remain intact. This pretty sums up confirmation bias, which is the tendency to believe things that support your beliefs and brush off views and even facts that challenge your views. As such, investors with confirmation bias also tend to search for information that support their views only and tend to ignore or don't bother to research on stuff that do not align with their standpoint or decision. For example, meta platforms aka Facebook. There are so many controversies and criticisms of the company, and it is a fact that a part of their fundamentals have changed. So if you are a Facebook investor and you have not realized this or choose to ignore them, then you are likely suffering from confirmation bias. Disclaimer, I have holdings for meta platforms too, but to be very frank, I believe those stuff that are surrounding the organization will definitely impact the company negatively. But that said, I am still bullish about the company's future for now. You may check out my other video for more information. Anyway, my point here is it is important to assess and consider both the good and bad sides of the company and then make an informed decision. One way to overcome this bias is that after you have gathered information that supports your opinions about a particular company or investment, you should deliberately seek alternative views that challenge your standpoint. Second psychological mistake is narrow framing, which occurs when an investor focuses only on one or two aspects of a situation and excludes other crucial elements. Such self-imposed restrictions to their focus will compromise their decision making. For example, investors bought Tesla stock at above $1,000, and for the last 1 month, Tesla stock has been floating around $900 and at times went to $800 plus. So panicky investors who don't consider other factors may doubt their investment choice. But when you look at things from a macro point of view, you will realize that Tesla had a very good Q4 result and its growth is massive. So the reason why the stock tanked is because the entire market is going through a correction, and the market sentiment is weak due to various factors such as interest rate hike, Russia-Ukraine tension, tapering from the Federal Reserve, etc. Another example is investors who are too obsessed on certain attributes or metrics of a company, for example debt to equity ratio or forward PE ratio, etc. That's a big mistake too. Not all cheap or value stocks are good investments. There could be underlying reasons why other investors are not paying premiums for the stock. So, the way to overcome this is really to pay attention to the larger picture. Also understand why did you invest in the company in the first place. I mean, if you had done your research and have high conviction in the stock, most of the macro and external factors are just noise. Third, anchoring bias. For instance, an investor identifies a well-known and successful company, and with this, he or she thinks that the company will continue to be successful and that the stock is a good investment for the next 2 decades. And that's a no-go. If you think that a company's stock is good hold for many years, it should be due to its projected or future growth, and not because of its past or present performance only. One got to understand the reality that any company can be here today and gone tomorrow. Look at Nokia and BlackBerry. And for those in Singapore, do you still remember this brand? Creative Technology. Another anchoring bias is mentally anchored to the entry price of your position. Sorry, I got to use meta platforms as an example again because I learned a lot from this stock. Anyway, my entry price was at $300 plus. When the stock price tanked to $200 plus, I told myself I should not be mentally anchored to my entry price of $300 plus. As things have changed for the company, I believe the upside for the stock will be limited in the next 18 to 24 months and likely not cross $300. If it does, good for me. If it doesn't, then my cash will be stuck there at $300 plus. Therefore, I presented 2 options to myself. 1. To cut my loss. 2. To average down to $200 plus. and I chose the latter after doing my research. So if you are stuck near the all-time high of $380 and not having a plan, I think you need to wake up, do your research and decide your next course of action. Otherwise, just be prepared to hold for a long time. Anyway, remember this, only you care about your own entry price. Nobody else cares. The market does not, other investors don't as well. Therefore, the way to overcome this is to be nimble and objective. Be open to new sources of information and learn to look at things from a macro view. Next, herd mentality or FOMO. Basically, it happens when investors follow and copy what other investors are doing. Usually, investors who commit this investment mistake is either they are too lazy to do their own research, aka ignorant, or they just fear of missing out, FOMO. These people are usually influenced by emotion and instinct. I don't know how people can invest through instinct, but somehow I fell for this trap too. Long story short, it happened one day when I saw everyone on Reddit forum jumping onto this stock called IronNet, a cybersecurity firm, and it was going to the moon. So I got FOMO and went in. End of story. Okay, anyway, I thought the short squeeze could last a while, like AMC, but lo and behold, it only lasted for a day or two. After that, I researched on the company, which I know it was too late. That's when I realized how shit the company is and I officially became a bag holder. For those or everyone who is capo, aka curious, I bought the stock at $30 plus and now it's currently standing proudly at only $3. Another thing to highlight, other than meme stocks, one shouldn't FOMO even for mega cap stocks. One good example, Google, who recently announced solid Q4 earnings and a stock split. This caused FOMO investors to rush into the stock, pushing the price from $2,700-ish to $3,000. But within a few days, it fell back to $2,700-ish. As I have always shared, don't chase a raging bull. Pullback and correction after a massive run is very common. You can check out my other video for more information. So anyway, the way to overcome this is think logically, not emotionally. Easier said than done. But whatever it is, please analyze at least the fundamentals of the investment to determine whether is it a real deal. Or be like me, pay some school fees to learn from the market. Fifth mistake, illusion control. This is the tendency of investors to believe that they have the outcomes of the investment market under their control. In case you wonder who on earth thinks they can control the stock market, well, you will be surprised that many small-time players believe they have this ability. Chances are they are wrong. I mean, it may be true that some investors can get things right most of the time, thus making them really rich in the market. But it will be dangerous if the so-called successful investors or traders get complacent and fall into the illusion control. Always bear in mind that random things can happen, such as the pandemic, Cold War, financial crisis, etc. And to some degree, illusion control is closely linked to the next trap, which is overconfidence. Sometimes we tend to remember only the success, but not the failure, unless it's a painful one. It is easy for someone to become overconfident when they are on a winning streak, or the stocks that they pick are flying to the moon. For example, last year I thought I was a good long-term investor too, as my stocks were all giving me 10 to 30% returns. But little did I know that 2021 was a bull market, and S&P 500, which usually generates an average of 10% return, gave about 26% return. As they say, everyone is a genius in a bull market. So it's only towards the end of last year and early this year I realized that one cannot be overconfident as my portfolio tanked. Anyway, that doesn't concern me as I am a long-term investor, but it was a humbling experience. So the point is, even if your investment rationale is solid, that doesn't mean it will work all the time. Here's a quote to share. The stock market can remain irrational longer than you can remain solvent. Anyway, the way to overcome this is really what they say, own self check own self. It may sound stupid, but the better term for this is called self-awareness. And of course, this doesn't just apply for investing, it applies to our daily lives too. Remember to stay humble, stay curious, and keep learning. Alright, that's all for this video. Did you commit any of the investment mistakes mentioned above? Let me know in the comments section below. Lastly, thanks for watching my video. Hope you can like, share and subscribe to my channel to show a little support. Thank you.